will start in about 2 minutes.
Your mic testing.
Testing, 1, 2, 3.
Okay, you're live.
Hi, I'm Jim Jubak, and thanks for joining me on, well, this experiment into new territory on YouTube and Instagram Live. I'm wearing my District 51 cap from Las Vegas minor league team, no longer called the District 51s, but this is in honor of both the release of all those UFO documents, and probably there are pictures of people you know in them, as well as to the fact that we're going into new territory, at least for me. This is a live Q&A. So you can find my regular site, which is JubakPicks.com, free, at that address, JubakPicks.com. My subscription site, JubakAM.com. There will be links to both of those down below. If you like this video, please like it and subscribe. That way you'll get notification of whenever I'm doing a new video, and we'll become friends, closer than we were. Okay, and this video will be posted on both YouTube and Instagram.
Instagram Live right now.
Instagram Live, so you can catch it later if you want to relive this experience.
Yes, it'll be on YouTube.
Okay, so people have been sending in some questions beforehand. If you want to send in a question now, my glamorous assistant off camera here will be able to receive those, but we'll start with some that we've already...
Drop it in the chat.
Drop it into the chat. We'll start with what we've already seen. We'll start with a specific one. I got a question last night on JubakAM.com and today on both that site and on JubakPicks. I recommended Ford as a member to add shares of Ford to my JubakPicks portfolio. And one of the questions I got was, why Ford versus GM? If we look at some charts, we put up the GM chart, we get some indication of why. You notice that GM has been moving up fairly regularly. GM has gotten a lot of interest because people think that they're going to do a lot in the electric car space and in the autonomous vehicle space. So it's been moving up relatively early. Ford, on the other hand, if you'll notice, has been really flat for a long time and then just started to go up recently. You got to keep these two charts in balance because you're really talking about moves off a very different basis. I mean, Ford is only a $15 stock. So it doesn't take a whole lot to get that kind of parabolic rise that you got here. But what I'm interested in, the reason I recommended it as opposed to GM, is that Ford's got a lot of very specific near-term good news. That they've launched a electric Mustang, which is selling really, really well. They've announced a electric pickup truck, the electric version of the F-120, which is the world's best-selling pickups. Those are both big, big things. The company's gotten its handle around some of its expenses. Its margins look like they're going up, and you're starting to get talk about maybe reinstituting the dividend. It will be a huge boost for the stock. A lot of investors a lot of professional investors or fund investors can't buy stocks that don't pay any dividend at all. And a lot of individuals are looking for dividends right now. So those would all be big, big boosts for Ford. So I put it in the portfolio with a 1-year target price of about 21. As I said, it's about 15, almost 16 when I made the recommendation. So that's the story on Ford versus GM. Important to remember, a lot of the portfolios are different time frames. The JubakPicks is a relatively short-term portfolio, so we're looking at trying to make gains in 12 to 18 months. So that's the time frame I think that Ford is a better bet than GM. Okay, what other questions do we get in? We got one from a Marie D'Amico, who said, "What's my advice to someone who wants to start investing but has never done it before?" My advice is, well, you should immediately subscribe to JubakAM.com and follow along. And that's said facetiously, but also seriously, because you've got two options as a beginning investor, and I think you need to follow some combination of them too. One is that you probably ought to be putting your money into some kind of index fund, because index funds have really good track records. That way you'll track the market as you learn. But you should also put a little bit of your money aside as a kind of educational experience. I'm hoping you don't lose money in this pot, but what you're trying to do is to learn something about how the market works. You can just keep putting your money into index funds, but there's so many index funds out there that you do need to have some understanding of how the market works, even to pick among index funds. So what I'm suggesting is you take some of your money and put it not in a black box or an index fund. An index fund really is a black box. You really don't know what's going on except that it's following an index. And find a site that, like mine, but there are others out there, where they give you reasons for why they're doing what they're doing. As I said, if you're a beginning investor, what you really want to learn is something about how the market works, so that you go from a situation now where if you're a beginning investor, you say, well, gee, there was good news today, but the market went down. I don't understand that at all. And the problem is when you don't understand something, even if you're in an index fund, you might have the impulse to sell because you don't understand what's going on, or buy at the wrong time. So a little bit of education there, even if you're investing in an index fund, even if you're a totally passive investor, would be good, so that you can understand why moves are happening, what moves are significant, what moves are just noise, and what moves you want to pay attention to. And the more you know, the better you'll do, even on your passive investments. Okay, that's my sort of advice to someone who's just getting started. Let's try another one. What's next? Okay. We'll go from that for the very beginning investor to a question I got from one of my subscribers on JubakAM, who's been following along. I've noticed that he's commenting very, very frequently, asking a lot of questions, because I'm pursuing some options and hedging strategies.
What's his name?
I don't remember his name, because all I have is an email address. So I don't know what his name is. I do know his name. I could find it, but right now I can't. So what he wanted to know was, well, what's my options strategy? How am I thinking about using those? And I'm not an options trader, but to me, options and hedges, which are related topics, that have a very specific role. That what I'm looking to do is two things. One is that I'm trying to use options, which are very much more volatile than stocks, to sort of leverage volatility. So one of the things I've been doing recently is buying a lot of call options. These are options that will pay off with a profit if the underlying asset goes up. I've been buying call options on the VIX, which is the CBOE S&P 500 Volatility Index. And what this is an index that tracks how much traders and investors are willing to pay to hedge against risk in the S&P. So the VIX is known as the fear index. It goes up when markets get more fearful and people are willing to pay more on the hedge. It goes down when people are complacent. And what I like to do, and this is just one part of an option strategy for me, is to play that swing from complacency to fear and then back again. So I tend to try to buy the VIX when it's at 16, 17, below 18, willing to sell when it gets up to 24, and then play it again. This is just, if all you were doing was buying the underlying asset like the S&P itself, there wouldn't be enough movement, wouldn't be enough leverage to make these pay off. But so you buy using an option, whether it's the VIX, I've also done this with Disney recently, MGM Resorts, Wyndham Hotels. The whole point is to try to find things where you can figure out what's going on with volatility and try to leverage it. The other thing I use, the other way in which I use options and hedges in general is longer term risk. So that right now in this market, I'm worried about the fact that over the next 6 months or so, we've got a whole series of events. We've got a Fed meeting next week. We've got a Fed meeting where they might say something about interest rates and inflation. There's a big central bankers confab in Jackson Hole in August, where traditionally the Fed has, if they're going to make a policy change, they've used that meeting to make it. We've got the September Fed meeting and December Fed meeting. All of these are occasions in which the market can sort of wrap itself in worry about an increase in interest rates, an increase in inflation, or the Fed simply saying, hey, we're thinking that instead of letting interest rates run at this low rate until 2024, we're thinking about maybe 2023. Interest rates are probably the major foundation for the market being at these levels. So any shift in interest rates could wind up having a big effect. So in that kind of time frame, options don't work really well because options tend to be very time limited. So you can buy an inverse ETF on the Russell 2000, for example, or indeed use options. So I've been buying longer dated options, September options, to hedge against risk. So those are the two ways in which I'm trying to use options around what is still, in my mind, basically a equities first investment strategy. Okay.
So Jack was asking, how can I buy the VIX since I don't have much experience with options? So you were kind of talking about that.
Okay, how can you buy the VIX? Jack asked, how can you buy the VIX? You don't have much experience. Okay, there are ETFs that trade that where you basically can buy the VIX using the ETF. So that if you don't want to buy the options or you don't have an account that lets you trade options, you can buy. Just go in and find. There are ETFs which basically short the VIX. There are ETFs that go long the VIX. What I would recommend is that you're trying to right now you want to go long. You want long VIX, a long VIX ETF. I don't remember the ticker offhand, but there are a couple out there, and you can do that instead of buying the option itself. Okay.
And then we have another question from Jay.
Okay.
It says, if it is 2025, which stocks would I regret? I did not own. With housing market at peak, stocks going up crazy, interest rate this low, which space looks like it would grow?
Okay, if you're looking at 2025 from a perspective of 2021, I think what history tells us is that buying stocks that are at the cutting edge of big technology trends and if holding them in this period is a good strategy. This is sort of the strategy beyond. I run one of the portfolios on the sites is called 50 stocks. it's 50 best stocks in the world. These are stocks with long-term competitive advantages, and I've been looking to hold these for 5 years or more based on the fact that they show some kind of technology or marketing trend or whatever advantage. So if you're looking at, and I'm gonna use a product from one of my sponsors, water. It's wet. So if you're looking at that time span, I'd look at a couple of things. I think you'll regret it if you don't have enough exposure to artificial intelligence. I think you'll be unhappy if you don't have enough exposure to alternative and renewable energy. I think you will be unhappy if you don't have enough exposure to cybersecurity stocks. So if you look at those, you can say, well, in artificial intelligence, probably the best single stock to own, if you want to start a position looking in that area, is Nvidia. They're a chip maker, but their chips are sort of the backbone of artificial intelligence. I mean, ironically, of course, they started as a maker of very massively parallel chips for game players, but those turned out to be really good for artificial intelligence. So Nvidia is a member of the portfolio with that attitude. If you're looking at alternative energy, I would actually look to buy some copper stocks, because if the uses of copper in an electric car are about 2 or 3 times greater than in a conventional car. We're going to rewire everything. We're going to put chips in everything. So you want to look at a copper producer such as Southern Copper, SCCO, or maybe First Quantum Minerals. FQVLF is my vague memory. They're both in the portfolios. If you're looking for cybersecurity, ransomware is just the tip of the iceberg. I think that we're looking at almost $500 million paid in ransom over the last 12 months. As far as we know, a lot of ransom payers don't advertise the fact, because that then puts them on the radar screen for other people who want to do this. So it's clear that we're moving into an area where more and more cybersecurity needed. The one stock that I own in the portfolios is Palo Alto Networks, PANW, and I like them because they've made the transition to putting their security product up in the cloud. Other companies look at our CrowdStrike, for example. Okay, we got another question?
We do have another question.
Okay.
Bahadur says, where do you see electric vehicle industry heading in the next 2 to 3 years, and do you see any small players having potential of getting bigger in that industry?
Oh, the problem is that if you take the car, great question, problem, because there is a problem here. And the problem is that, electric cars are, they're not that hard to build. Tesla has got major advantages in terms of battery packs and efficiency, but within 2 to 3 years, I'd be really surprised if at least Volkswagen and some of the Chinese manufacturers haven't eradicated those advantages, especially if we get a new generation of batteries. So if I were looking at this and I were looking like 2 or 3 years out, I'd say that the key issue in terms of erasing Tesla's competitive advantage is going to be battery technology. Unfortunately, there's not a whole lot in the way of public battery makers. There's a big Chinese battery maker. I'm leery about recommending any Chinese stock right now because of the Chinese government's involvement in its equity markets. VW just made a big investment in a Scandinavian battery maker, which looks like it's going to be the battery maker for Europe, at least in terms of the number of factories. The big speculative play out there is QuantumScape. QS is the ticker. They went public using a reverse merger and a SPAC, so they were special purpose acquisition companies. So they got really hammered when everybody decided that SPACs weren't the greatest thing since sliced bread. Instead, were a scam. They're neither. There's somewhere in that nasty place in between that we call reality. So QuantumScape is probably 2 years away from a battery if they score. If they do what they say they're trying to do, which is to produce a solid state lithium ion battery, big winner. If they don't, nothing, nada, no money left. Volkswagen thinks enough of them is to put $100 million in, which is validation, but on the other hand, for Volkswagen, which just put $300 million into the Scandinavian battery maker, it's one of a number of bets, and it's not going to make or break Volkswagen if it loses $100 million. Unlike, if you or I lost $100 million, we would probably feel it immediately. So battery makers I would look at. There's a Japanese electric motor company called Nidec, Nidec, NJDCY, I believe is the ticker. They are the big producer of electric motors, from really small ones that are used in things like robots, and perhaps you have an idea that robots are going to replace more and more workers, and more production going to be robots. So that's a growth industry. They have recently gotten into the electric drivetrain industry, and one of the reasons that electric cars are not that difficult to produce is that, hey, if you and I wanted to start an electric car company tomorrow, we could buy most of the components, like our drivetrains, from an outside subcontractor. Trying to find extensive competitive advantages are really difficult. On the other hand, if you want to own a Nidec, which sits across the Sea of Japan from all the Chinese manufacturers, is opening a factory in Serbia, initially reported as being in Siberia, which didn't make much sense then, makes less sense now, but it's not. It's a factory closer to the heart of Europe, looking to get in with BMW and all the German makers. So this is a growth industry, a very conservative Japanese company, which basically has the kind of long-term strategic plan that you as a long-term investor might like, but at the moment doesn't really produce a lot of headlines or big jumps in earnings because they're reinvesting everything. We got another question?
Not from here. You want to?
Okay, so JS, I got a question about, could I do a portfolio, because I have now 6 portfolios I've been running for people who are nearing retirement, and one of the rules of having an IRA or a KEO or a 401k is that at some point in your retirement you have to start cashing out. You're required to withdraw a certain amount of money. This is a really tough set of decisions to make because right now there's a big debate in the financial planning industry about how much is a safe withdrawal rate, how much can you take out of your portfolio, and a lot of that is, well, how much on the other hand is our stocks going to grow? Are we going to revert to mean? Are we going to go down from mean? Are we going to, we've had 10 really great years, are we going to have 10 really, really bad years? One of the reasons I don't do a portfolio on this is because I'm not a financial advisor. There's an SEC exemption which covers people who deliver financial advice, as I do, and like a lot of other people do, as long as we don't know too much about you. So we can't really, the more that I know about you, which is what I would need to do to be able to give you good information on this, the closer I get to going over the lines. What I would say is that, I think this is one area where it's absolutely essential that you have a good financial planning advice or system or a spreadsheet or something like that, because you really do have to look at what money you have that you're going to need, what money you've got, what a growth rate is, and you need to come up with a plan for the selling. In terms of selling, it's a strategy that I've been looking at right now, because what you really want to do is you want to sell stuff that gives you cash that you need when you need it, but on the other hand, you would like to preserve the growth in your portfolio. This is a really difficult balancing act. And in some ways, what you might want to do is, if you're looking at a way to do this, you might want to look at combining some of the portfolios that I run. There are three that come to mind. One is the long-term 50 stocks portfolio that I've been talking about. These are long-term growth. So if you're looking at, say, you've got to start withdrawing from your 401k or your IRA in your early 70s, but you're still looking at 10, 15, 20 years of life, or for those of us who are going to live forever, even longer. So you want some long-term growth stocks, and that might be some place that you'd like to build a core in your portfolio. You'd also like to the degree that you can generate income as opposed to having to sell things, that's a good idea. So maybe you want to add some things from my dividend portfolio, where we're looking for, this is not a great time to find high yields, but you can find things with 3, 4, 5%. The more you get in a dividend, the less you have to actually sell things to raise the money that you need to pull out from your portfolio. And the last thing is that I also run a very simple ETF portfolio, 5 ETFs with some kind of asset diversification. It's not a rocket portfolio, but it's very, very solid. So if you put that into the mix, and that would give you a steady asset base that you might be able to sell part of as you need to do disbursement as you get older. Those would be 3 ways to put that together.
Okay, just to follow up, someone was saying NIDEC is not coming along well at the moment, but you're talking about...
NIDEC is never coming along well at the moment. And one of the reasons that NIDEC is not coming along well at the moment is, well, that, as I said, this is a Japanese company with a very long game plan. The CEO has said, hey, what we really want to do is we want to own this market, we want to own this market, we want to dominate this market, and we're going to therefore, invest in those. For American investors who are used to seeing, earnings growth of a certain amount or a certain kind of PE ratio, Japanese companies can be really, really frustrating. They're very odd things in many ways. So what you're doing with NIDEC is you're not looking to see what you might get over the next 6 months. What you're looking at is, if you're looking for some way to play the electric car industry and trend there over the next 5 or 10 years, NIDEC is a good place to go.
So we're almost out of time, but is there maybe one other thing you want to talk about?
Yeah, there is one other thing, which is that, underpinning a lot of this stuff, there's a sense of that, well, you don't want to, the lesson that we've all learned over the last 10 years is that you never want to be out of the market. And it's been hammered into us over and over again that when we have a big dip like we did with the pandemic in 2020, you want to either not sell at all, or you want to buy back because, hey, that was over in 2 months. We had a bear that was over in 2 months. And the conclusion that a lot of people have is you never want to get out of the market. And that becomes incredibly difficult when you're getting a situation where I think the trend is changing, that the underlying trend for the last 20 years, 40 years, has been lower interest rates, and that has propped up equity prices. We're looking at a reversal of that, whether we're moving to a situation where instead of the 10-year treasury is now like at 1.7%, looking to see that go up to 2.5%, 3%. Not a big change, but it's a change in direction. And I think one of the things you need to do right now is not get locked into where have you been, but look at where you want to go and where the stock market is going. Still the key thing is to pick good companies, but I don't think you can count on the rising tide to lift all boats going forward. Thanks very much. And again, buy more of my sponsor, water, H2O, it's good.
So do you want to just plug your site?
Okay, so next week we'll be going back to the regular videos on some topic. So If you like this video or like any of the other videos, just give us a thumbs up, say like, subscribe please. You can find more stuff of mine, every day on my free site, JubakPicks.com, including 3 portfolios, some of which I've talked about today. And there are more portfolios, in total 6 portfolios, on my subscription site, JubakAM.com. Links below. Thanks very much. I do the royal we.